Thanks so much for tuning into this very special conversation with the team from Citi. It's the pre-quarter conversation that we have with them almost every quarter, and it's a pleasure to have the team again. Surendra Goyal, along with Saurabh Handa, Rashi Chopra, as well as Arvind Sharma. All of you, thank you so much for taking the time out. Really appreciate your time, and a happy 2023 to you at the onset. Surendra, could the start of 2023 have a quarter which will be happy versus the expectations, or is there a chance of an earnings miss?
Yeah, Neeraj, Happy New Year to you as well. And thanks for having all of us here. See, on the quarter, our expectation is that it's a relatively muted quarter. For the Nifty companies, what we are expecting is around 6% earnings growth. So, in the context of elevated market expectations, which the valuations are pointing towards, it might definitely look a little muted. And we would watch out for some pockets like urban consumption, etc., which have held up very well, done well over the past calendar year. So I think trends on some of those need to be watched out for. So definitely 6% does look to be a little on the lower side.
Yeah. Well, if you're at 6%, Surendra, then the chances of you getting disappointed vis-a-vis a few other quarters of the market are that much lesser, right? In that sense. What about the overall universe? I mean, whatever universe that you track, because the Nifty may be a 6% growth. Are there
Yeah.
chances of disappointments at the broader end of the spectrum relative to what the market might be anticipating versus what you're penciling in?
Yeah. So if you look at our entire coverage, the earnings expectations are essentially flattish year over year. Okay, so that's slightly below the 6% for Nifty. So honestly, disappointment is difficult to call because again, some people are higher than us and some people are lower than us. But I think what is important is that when the market is trading at a significant premium, a flattish earnings or a no growth earning scenario is not really that great outcome, or at least the market might be hoping for a better outcome.
Hmm. Okay. Well, let's start off with maybe commodities, move on to autos, and then turn back actually to information technologies, which has kick-started this. Rashi, can I start with you? Um, it's not necessarily the heaviest space on the index, but very wide interest on metals. How are you looking at this quarter?
So obviously we come off the really tough levels that we saw, in 2Q for metals. More specifically for steel, there is a price correction that we're going to see in the sector, but should more than be offset by the correction in coking coal costs. So from an Indian steel stock perspective, I think by and large, we should see an EBITDA per ton expansion to the tune of about 3,000 rupees, give or take, across. The wild card for us here this time around is actually Tata Steel Europe. We are anticipating an EBITDA loss over there, almost $90 a ton. So why I say it's a wild card is because, again, that number could be anything. A loss, I think we're more or less sure will probably show up, but, that quantum could be whatever. And the second thing is that 35% of their contracts are annually driven. So, commentary around that, basically what happens in, calendar 23 would be something that we are watching out for. On the, on the non-ferrous side, more specifically, we've basically seen that aluminum prices have contracted, but then at the same time, we've seen, costs kind of come down as well. So to that extent, bit of a non-event in a sense on the non-ferrous side.
Hmm. Rashid, I was saying, and please correct me if I'm wrong, but I think a day or two ago, I think you and Surendra have gone ahead and changed the rating on the ferrous side. Now, is this the China factor to do with it? And therefore, would you play more, or would you put more importance on the commentary that comes in from the companies about how they feel about this whole China reopen, more than the earnings delivery? How are you looking at it?
Oh, yes, absolutely. The upgrade in the strategy portfolio as well is basically predicated on China easing. Our global team is actually pushing INO as a way to expose themselves to this whole China easing policy. We've already seen INO move up from like 80 to crossing $120, and we're expecting that to go up further. And when you kind of play INO, then that augurs well for steel as well, right? Because if there is a China easing, in a sense, we'll see steel margins expand. Particularly, the steel stocks that have iron exposure and iron integration, they kind of do well. So yes, like you rightly said, I think more than the earnings, because the earnings are kind of what we already know by and large, unless there are some massive surprises on the upside or the downside, either way. But that apart, I think the focus will have to be more on what China actually does, and perhaps more realistically after Chinese New Year. Because as I understand right now, on ground demand is really bad. It's quite sort of so muted that there has to be some sort of a pent up let out. And if there is an easing, that will, I think, propel the sector forward.
Hmm. Surendra, just before I move on to autos, because that's the other piece on China opening up, just wondering whether the calls across spaces which might get impacted because of a China opening, would these be tactical in nature because one doesn't know the extent of the demand that comes in, or would it be, or would you be certain of there being a slightly elongated thrust because of the China opening up for
Yeah,
autos, for metals, for whatever else?
yeah. So, Neeraj, if you look at the reopening trade across sectors across the world, they have generally tended to continue for some time, right? Even if you look at, even in India, right, you look at various sectors which are more exposed to a reopening trade, things were strong for almost 12 to 18 months. So I think there is a case for at least a decent upside over the next, I would say this calendar year for sure. So it depends on how, what you would call term as tactical. Okay, so it's, if the point I'm trying to make, it's not like a 2 month play. Okay, slightly longer term, but again, there are variables which we'll need to watch out for in terms of what China's growth is after the reopening and so on, to reassess our view maybe 6 9 months later. So that's how I would think about it.
Got it. Okay. Thanks, Surendra, for that. And which brings me actually to Arvind and autos in particular. We'll come to aviation later. But Arvind, how are you feeling about autos at large? Because the input cost pressures would have abated a little bit for pure domestic or global oriented names. And of course, there's this whole clash between the impact that a China open up has for certain global names versus what a Europe and a US slowdown means for them.
Sure, Neeraj. So you're right that the raw material cost pressures have abated a bit, and that's why we believe that in this third quarter we would see a bit of a gross margin expansion. However, third quarter, because of seasonality as well as a not so great festive season, the volumes haven't been too good. So at the EBITDA level, maybe the positive impact is slightly on the lower end. That said, in few sub-segments like tractors or commercial vehicles, we are seeing a very strong volume trend as well. So they would benefit from volume growth as well as the as well as the higher cross margin. So I think that is how it would play out. Uh, we are seeing a bit of a premiumization in some of the segments as well, notably higher end SUVs, higher end bikes. Uh, they are doing better. So again, players in those segments are expected to do slightly better on a quarter-on-quarter basis. In terms of what we are seeing in the global demand, I think it's more important for some of the part makers that we have in India who export to the US or Europe. So obviously, volatile demand in those regions could be a bit detrimental for these part makers, as well as some of the exporter OEMs that we have in India in the two-wheeler space. They are seeing a bit volatile demand as well. So that's how it would pan out um, um, for the exporters for India. Naturally, if there's some easing of the global supply chain, it's conducive for all the part makers as well as the OEMs.
Hmm. Relative to the valuations that they are trading at, Arvind, what's the extent of possibility of disappointment for two-wheelers in particular? I heard you mention that OEMs exporting, and therefore that puts the spotlight on two-wheelers as well, so to say. There is an input cost reduction. Valuations may not be at the nadir, but certainly not at peak either. And the sentiment isn't the most positive. So, what do you expect from the numbers per se, and what would you watch out for in terms of either the commentary or a particular statistic in any of the specific companies?
So Neeraj, two-wheelers have been a little disappointing in terms of volumes. After a long time, we are seeing that the growth in two-wheelers is lower than what we are seeing in passenger vehicles. This is especially true of the entry-level two-wheeler makers. As I said, the higher-end bikes are doing relatively better. So that's one part. Secondly, the competitive intensity is quite high. A fallout of slightly weaker exports is that there is more focus on domestic markets, and therefore the competitive intensity tends to escalate, uh, which could result in a bit of a pricing pressure across industry, across players. So I think what we would like to watch out for is the ability of these two-wheeler makers now to increase prices. We've seen a frantic increase in prices, I think, over the last 2 years. Can they increase prices further? A, because demand is weaker, and B, because competitive intensity is higher. So I think pricing is fairly important. Second thing to watch out for would be how rural demand plans out, because for two-wheelers, that's quite an important sub-segment of demand, the rural India. And that is the other part which would watch out for. Improving rural demand augurs well for these entry level two wheelers as well. uh, I think in terms of commodity cost pressures, they are low and they are uniform across the players. So pricing and the mix and demand would be the differentiating factors.
So just one quick follow-up, Arvind, and which is on whether you believe the earnings delivery from, let's say, CV companies and CV suppliers, be it the forging companies or be it any of the pure play CV names. That is part one. And then let's say from the likes of Eicher Motors, because I heard you mention high-end bikes are probably not seeing as much pressure. Do you think the earnings delivery from these companies would likely be strong?
Neil, so on the CV OEMs, they are more domestic plays, and I said that this is one segment which has seen a good volume growth. That should definitely help the CV makers because there also operating leverage plays a strong part. I think that should be good. In some of the forging companies, I think it's not just the domestic commercial vehicles play; they also have a lot of global exposure. So we have to include domestic commercial vehicles, domestic passenger vehicles, and as well as US and Europe commercial vehicle segment as well. So maybe that could be not as great as the domestic commercial vehicles play. So domestic CV makers are expected to do better. Coming to Aisha, yes, the higher end bikes are doing well. They are one of the few OEMs which have seen a quarter-on-quarter growth in volume. So that's also a positive part. The only imponderable at this moment is that they have launched a new vehicle called the Hunter. And what's the impact of the Hunter? It's a first full quarter of the Hunter. The impact on EBITDA margin. So that's an imponderable. But in terms of volumes, definitely they are better off compared to some of the other two-wheeler makers.
Great. I'll come back on aviation. Arvind, let me get in sort of in this conversation as well. Sort of thanks, and just between telecom and energy, I'm tempted to start off with energy. What's your sense? It's been as volatile a year as it can be. As for Rashi, so for you, what's your sense about how the quarter turns out?
Yeah, hi. So in terms of the quarter, I would say there are three or four key, changes that have happened. The first is for the OMCs on the marketing side, things are looking better this quarter. So amongst the two fuels which haven't seen any price changes over the last 8-9 months, petrol has now turned positive in terms of margins, and diesel losses have also narrowed significantly. So on a QOQ basis, this should be a positive driver for the OMC's earnings performance. The second thing is on refining also, underlying product cracks have improved sequentially. So that should also be a positive for the OMCs. On the third point, I would say, as far as gas is concerned, there was the domestic APM price hike that happened in October. That usually that's an input for the city gas company. So all else being equal, that tends to hurt their margins. And we've noticed that companies like IGL, Gujarat Gas, etc., have not yet fully passed on the impact of this to consumers. So you could see a contraction in margins for CGDs in the quarter, especially for the likes of IGL and Gujarat Gas. So I would say these are the three broad trends that we have seen in the sector, at least in 3Q.
Okay, and are you constructive on OMCs, and could quarter three, because I heard you mention that there are some trigger points out there, that could this quarter mark some sort of a resurrection of fortunes, if you will, for an HP or an IOC, so to say?
Yes, it's possible. So in OMCs, obviously, what matters is the macro backdrop. So if oil prices continue to remain soft, we have seen a softening. They have settled at closer to the $80 mark right now. If that sustains potentially with maybe some downside, then yes, that should definitely be a positive for the OMCs, especially for those who are more geared to the marketing side of the business, like HPCL. The second thing, yes, 3Q should see a marked improvement. But I think the other point that maybe investors could be focused on is what happens on the past losses, because in 1Q and 2Q, these companies made significant losses. There has been a bit of a clamor for them to be given some compensation by the government. Is that possible or not remains to be seen. Maybe one important event to watch out for will be the budget, if there is anything budgeted in terms of subsidy compensation for them. The third thing is obviously fuel prices itself. I mean, we have seen these frozen, but is it possible that once inflation starts, the inflationary base effect starts becoming more favorable, is there a possibility of us returning to, marking to market fuel prices? So these are two or three key things to watch out for. Given where valuations are right now, close to trough valuations, we believe risk reward is attractive on a selective basis for the OMCs.
And just one quick follow-up, Saurabh, on upstream. For all the conversation around how they are pricing in crude at $40, $50, even when crude was 120. These stocks don't tend to move depending on numbers, but likely dependent on crude prices. Do you reckon that irrespective of earnings, and maybe because of earnings, or however, the fortunes of likes ONGC, Oil India, etc., do they stay subdued, or could there be something different there?
So for as far as the oil and gas realizations for these companies are concerned, as long as crude is above the $70-$75 level and the government, regularly adjusts the windfall tax, their crude realizations should be broadly intact. On gas realizations, there was this committee that submitted its report a couple of months back to cap the realizations on the gas side for companies like ONGC. But that said, if you look at overall earnings for these companies in a current scenario, they should be decent enough for them to be able to at least give out attractive dividends. So from a dividend yield support, I guess that could be the one positive. Where we remain a little more concerned is on the core operating performance. Companies like ONGC have been disappointing on the production front for the last few years. We have been seeing a decline in both oil and gas production. Now, this year, the company is, talking about a revival, and I think that would be key to focus. If you do have an improvement in both oil and gas production, as the company is expecting, especially from their KG block, then that can, potentially lead to further investor interest. Otherwise, I would think it will be probably more of a dividend yield play at this point of time.
Got it. Surendra, can I shift the focus on IT? We've had one release which has been a mix of both positives and negatives. So how have you read into what TCS said, and what is it that you are largely expecting from this space to deliver in Q3?
Sure. So, Neeraj, if you look at the TCS earnings, okay, I would rather focus on the forward-looking indicators. Because I think what they reported is essentially revenue from the past and deal flow from even a few months or few quarters back. So if you look at those indicators, firstly, the headcount declined. Okay. And if you kind of look at what they said in the press conference, etc., and then what any corporate would normally do in a fourth quarter in a tough year, I wouldn't assume that a lot of headcount will be onboarded. So they could possibly end the year at a headcount growth of around 5%, 4%, some number like that, right? So that is telling you how the management is thinking about next year at this point. And obviously, all these assessments can change as you have more data, more feedback from clients. The second thing to look at is the TCV. For the first 3 quarters, we have been in the $8 billion a quarter kind of a range. Okay. And that compares to 34, 35 billion last year. And just to put that in perspective, you could just go back and see ever since TCS has been disclosing TCV growth has been pretty decent year after year. And this year it looks like we might be ending somewhere flattish. Okay. If you look at this quarter TCV, both North America and BFSI, which are two very significant pieces of the business, in both there was a decline in TCV. Okay, so looking at the forward-looking indicators, I tend to be still a bit cautious. Okay, having said that, I think in the sector there is an interesting debate going on when I'm talking to our clients. There are a set of clients who are like the 30% underperformance last year has priced in a lot of these challenges. Okay, so incrementally that doesn't matter. And on the other side, there are people who are still worried about what happens to the US and the global macro and things still going down from here. Our only submission there is that if valuations had come down to a point where some of this risk clearly felt priced in valuations, I think one could have argued differently. But today, the sector even today trades at 22 times 1 year forward versus a pre-COVID 3-year average of 18 times. So definitely it doesn't feel like that the risks are fully priced in, and there is a lot of uncertainty out there. As you heard the TCS management say, European decision making is what it is, and even US decision making is tactically a little slow, and they hope that it improves. But I think that we'll have to see how it plays out in the next 3 months. So overall, we are still cautious. From other companies' perspective, I don't think the trends are going to be that different. I think people will start focusing a lot on operational resilience, and you will see utilizations going up, headcounts possibly declining to remaining flat. So I think trend wise, you would see a lot of other companies do in some ways what TCS has already done.
Surendra, just wondering, is there a chance of bottom-up companies being outliers? Do you have thoughts on any of those? Because I mean, in December we did a conversation with the managements of, as in a common conversation with Persistent and Emphasis, who are very constructive on the kind of growth and the conversations that they are having with their clients. There is a thought that the ER&D companies might actually turn out to be a separate chapter compared to what the IT services is doing. So I wonder if bottom up, do you believe in earnings growth ability of select companies vis-a-vis what the sector at large might throw up?
Yeah. So Neeraj, that can always happen. Okay. Again, if your question is on the quarter, that happens all the time, right? Quarters are not
Also,
that easy to call more for smaller companies,
uh,
right? But if your question is more medium term, it could still happen. But what I always say is that if suppose IT spending was growing at say 6%, and just throwing a number, and that goes to 1%. Okay, every company is impacted. What differs is the extent to which somebody could be impacted given their portfolios, right? So if today somebody doesn't have a tech exposure, they might be feeling better versus 1 year back. If you had tech exposure, you would be feeling better. So those kind of things are always going to drive. And even within tech, I'm kind of just generalizing. Within tech, you could have an exposure to the cloud companies, and you could have an exposure to some of the equipment makers, and the outcome might be very different. So those kind of nuances are always going to be there. But what we are saying is that if based on whatever data points are there, it seems like a fairly broad based deceleration. Okay, and to that extent you will see, and again the companies which you named are also seeing an impact, right? What the company which was growing 4% a quarter last year is growing expected to grow 1% a quarter. The company which delivered 8-9% growth is expected to grow 4-5% growth. So everybody is decelerating. Some are holding up better than others relatively.
Okay, point well taken. Thanks, Surendra. I'll come up at the end with banking for you, with you as well, because that will also be a determinant of what the index does. Let me just quickly get in the second sector from each of our other participants. Rashid, may I come to you for cement, Rashid, and a space whose fortunes are debated about the kind of capacities coming up versus and the ROCs they are throw up versus the near-term pricing impact that comes in. So tell us on both. One, what do you expect from the quarter from select companies under your coverage? And what do you expect the year to throw up?
Sure. So for the quarter, Neeraj, I'll kind of split it between the Adani Group companies and the other companies. First, talking about the remaining companies, the trend basically on the pricing side, we're expecting marginal price increases with the East exposed companies perhaps seeing a little bit higher price increases. Some marginal decline in power and fuel costs, and because the bulk of the impact on the lower coking coal should probably kick in the fourth quarter. And because we're past the seasonally weak quarter, then there should be some sort of benefit on the fixed cost side. So by and large, there is an EBITDA per ton expansion across somewhere in the range of about 60 to 250 rupees is what we've kind of factored in our numbers. The reason I said we separate the Adani Group companies is because ACC Ambuja did take a pretty big hit on their power and fuel costs in 2Q. And I anticipate that that will reverse in a sense that their power and fuel costs fall about 15 odd percent, for them this time around. The wild card here would be if there are any other efficiencies or surprises, that the ownership change bring about. That is something, which is hard to kind of factor in at this point. But even just taking that 15% decline and the remaining factors being, the fixed costs as well as, the realizations as is, here the EBITDA per ton expansion is anywhere in the range of 400 to 500, on our estimates. On the volume side, the industry seems to have done well. Some of the larger companies like Ultratech, Shree, they should be reporting double-digit volume growth. ACC Ambuja's case, we've taken a little bit more moderate numbers, reason being that last year, December was a year end for them. So they're already coming off a higher base, effectively. So, that's how we kind of segregate the quarter. So really looking out for any, sort of promoter-driven change announcements on the Adani side and general commentary across board on what's the likely pricing status. From whatever we understand, pricing in January hasn't been extremely gung-ho. We've heard some price cuts in some region and marginal cuts. Some regions have been marginal increases. So nothing, really moving too much, at least so far. So that was on the quarter. To your other question on what we can expect in the year, we feel that consolidation that everyone's talking about may not necessarily be positive from a pricing standpoint. A few reasons over here are, one is that we expect almost 35 million tons of supply to come in, despite whatever consolidation we're talking about, despite whatever M&A we're talking about. Per annum, 35 million tons of supply, and the bulk of it is by larger producers. The likes of Ultratech, Shree, Dalmia, ACC, Ambuja, which effectively means that these are serious, producers. It's not just flaky namesake capacity that's going to come. And if this were actually to come, the ask rate for demand just to absorb this is about 7%, which means that demand has to grow higher for utilization levels to kind of move up. The second thing is that if Adani, again, we're waiting for strategy from them, but if really they are focused on M&A and if they're focused on market share gain, and they have the ability to pull levers to kind of reduce their cost structures, I'm not sure if they would be kind of pushing price increases, especially at a time when they want to kind of do M&A. Third is, historically, we've seen consolidation doesn't necessarily lead to price increases. Between FY14 to FY21, almost 72 million tons change hands. These include like the Ultratech JVA acquisition, etc. And the pricing CAGR during this period has been sub 3%. So all in all, we aren't very gung-ho on the, on pricing. And therefore, most of our recommendations are split between, buy, sell, hold. But, the buys are more either driven by very company-driven factors or by valuations.
Okay, just wondering, where are you constructive, Rashi, within the space? I mean, whatever disclosures you can make, otherwise completely okay.
No, absolutely. So we are positive on the, like I already spoke about metals. So we have buys on Tata Steel, Jindal Steel, and we have a neutral on JSW Steel. I'm just keeping, just kind of naming the companies which I can talk about. And on the cement side, we have ACC Ambuja are our top picks. We also have buys on Ultratech, Grasim, and Novoco.
Wow. Okay, great. Rashi, thanks for that.
Sorry, one more. I'm sorry, I missed one more. NMDC, which we have a buy on, and we've also opened a positive catalyst watch on that.
Okay, great. Thanks for laying that out. Speaking of consolidation, actually, Saurabh, can I quickly get you in on the other aspect, which is telecom? There is again a bit of a mixed view on Airtel, the pure play telecom company. So I'll talk to you about that. What do you expect in the quarter? Could there be negative surprises?
Okay, so there's unlikely to be positive surprise, let's put it that way. So there wasn't really any major pricing action in the quarter. So you should see some ARPU improvement happening in Bharti by the organic mix improvement as the 2G to 4G upgrades continue for them. But yeah, in the absence of any major tariff hikes, we aren't looking at any major significant positive beats. Obviously is on pricing action. There has been chatter for the last couple of months that tariff hikes should be coming. I would say the general expectation maybe was that in November and December you could have seen some pricing action. That's usually been the case over the last 2, 3 years, where towards the end of the calendar year they announce a tariff hike. That hasn't happened this time around. Maybe there's a bit of disappointment around that. Our own view is that it's not something to be particularly worried about. As I was also highlighting in the case of fuel prices, the inflation base effect starts getting a bit more favorable in India after March. So it's always possible that you could see some pricing action happening then. Secondly, coming to your point on consolidation, that's still pretty much happening. There are market share gains for both of the key large players. And the third player, Vodafone Idea, there has been a fair bit of news on delay in their capital raise, primarily because of delay in the conversion of government interest to equity. So it appears like things there have just stalled for now, and it's a bit of a stalemate. And the longer the capital raise gets delayed for them, market share losses could continue for them, which then benefits the two stronger players. So overall, we remain positive on Bharti. We still believe. That tariff action should be a positive for the stock. We believe valuations at 8 times 1 year forward consensus EBITDA are still fairly reasonable, especially in the light of EBITDA growing at mid-teen CAGR over the next few years.
Maybe Q4 might be the right quarter to talk about what's happened to pricing as well. So thanks for that. Arvind, the final question to you, and then I'll wrap up with Surendra. Aviation, world opening up, lower crude prices, all of this augurs well. Plus in India, the way some of the other carriers are kind of operating, there is a bit of a preference towards the more stabler ones. What's your sense here on InterGlobe?
Neil, you're absolutely right. We are seeing an increase in traffic in airspace, though we are not yet at the pre-COVID levels. And also this third quarter is seasonally strong because of vacations and holidays. So I think we are seeing a bit of traction there, and you're right, with crude prices coming down, even the air traffic, aviation turbine fuel prices have come down. It helps either on the margins or gives some leeway to companies to cut prices. However, beyond just the industry, within players, we are seeing a lot of restructuring. We've already seen the erstwhile flag carrier merging with the other airline. We've seen the coming up of a new carrier over the last 4 or 5 months. So I think within the industry, we are seeing a lot of restructuring. There's a lot of competitive intensity. I think at the end of the day, the market share would be a function of the kind of offering we have in terms of ticket prices. I think that that helps a lot in terms of gaining market share, and obviously the route network that companies operate in. Naturally, there could be some short-term issues, but we've seen that in the past that ticket pricing and route network are the two most important things that decide the long-term market share trends. We have seen a lot of a lot of variation in market share trends already over the last 5 or 6 months, and it won't be surprising if we see the trend to continue. Some of the companies which were very low in market share, they are gaining a bit of market share as well.
Okay, Arvind, thanks for that as well. Surendra, final question, and BFSI, the largest weightage, what do you anticipate the quarter to be like? And then rolled up into that question is the prospects for the index if indeed IT earnings don't quite set the stage on fire, and if BFSI is largely on expected lines, that's a large chunk of the market delivering either on expected lines or maybe slightly below.
Sure. So on the financials, the numbers are looking pretty strong. What we are expecting is a 40% plus earnings growth year over year. Now, again, I would obviously put it in context that this is one of the sectors where expectations are also high, right? We know what the credit growth data is and so on. So it's a high expectation sector, but the numbers are coming through. And at least for banks, we like this quarter should be pretty good, both on growth as well as margins. Okay, NBFCs is where we are expecting some NIM pressure to start emerging, as there is competitive intensity out there and it may not be easy to pass on the hikes to the customers. Okay, and then on the insurance side, again, the trends are decent, I would say, where given the mix, and again, it varies a bit across players, but with a favorable mix, companies are still reporting very good VNB growth. So I would say financials is still looking quite good at the moment. Obviously, we would watch out for NIMs as we go forward, and then asset quality is something which we are always looking at. So far, trends have been pretty supportive, but suppose on the MSME side, if there are data points that emerge which show any kind of building stress or early stage sign of stress, I think the market will start worrying, because this is a sector which has also done well last year. So all those things need to be kept in mind, but for now, earnings momentum is looking pretty solid for financials.
And therefore, what does it mean for the index? I mean, if they deliver on expected lines, but IT doesn't, some of the others might have an issue or two, as our other friends have spoken about as well, selectively. What does all of this mean for the index at large?
Yeah. See, from a Nifty perspective, from an earnings perspective, we are expecting this year's growth to be approximately 12%. Okay, and when you look at consensus, it's broadly in line. Next year, we are at 13 odd percent, and consensus is around 4 percentage points higher than us. So to that extent, our numbers are already baking in some caution or conservatism. See, from a valuation perspective, what we still think is that we are in a pretty range-bound market with the expectations we have. Because I started by saying that there is a little bit of a slowdown on urban consumption. That's something to watch out for. And overall, I think from a global investor perspective, I am seeing some appetite coming back for other markets. Like last year, for the most part, it was like India, there is no alternative kind of a theme. That is also changing. So I would think that it looks more like a range bound market. And if you look at our Nifty target for this year, it is 18,300, which is pretty much broadly where the market is. So that's how we are thinking about earnings as well as the market outlook for this year.
I think as I think Howard Marks put it, from Tina, time to move to Tara, which is there are reasonable alternatives. So could be interesting. But all of you, thank you so much. Really appreciate your time this morning and talking to us through your spaces.
Thanks, Neeraj.
Thank you.
The pleasure is ours.
Thank you.
Thanks for tuning in.